Hello everyone, welcome to Demand Supply Trading Practical session number 40 for the year 2024. Myself, Srijit Kakkar, and today is Sunday, 20th of October 2024. And before we move ahead, let's get done with the basic formalities. So make sure you people go through the disclosure, which talks about the representation, risk disclosure, risk involved in the market, and also about the copyrights. Now, before we move ahead, I would also like to add that yes, we definitely have a channel on WhatsApp, but now we are trying to be a little bit more inclined towards Telegram. Just give me a second. Let me fix this. All right. All right, perfect. So fixed. So yes, getting back to we are inclining a little bit more towards Telegram, and the reason for that is there are a few limitations with WhatsApp, so that channel will still be there. We will keep updating you regarding upcoming sessions if you have any offers. But the Telegram channel will be a little bit more, I'll say, better user experience. A very simple example is that on WhatsApp we cannot share files with you, right? But on Telegram we can share files. So if you see recently, we shared the rule book, we shared the flow chart. So that is where we have a few more features which can be much more better when it comes to user experience. So that is why moving forward, I would request you people, yes, if you're interested in joining our channel, you can join the Telegram channel. The QR code is available on the screen. Otherwise, you can also find the direct link in the description. And by clicking on that link, you'll be able to join this Telegram channel. All right, so today's session is practical application of demand supply methodology. So our demand supply course is now available as a 100% free course. And by going through the course content, you'll be able to learn the methodology theoretically. Now, what happens is once you have learned the methodology theoretically, unless and until you see some practical examples, at times it becomes a little bit challenging to get around the concept how it has to be applied. And that is what we do in these sessions. In these sessions, I take some practical examples to which we apply the complete methodology. Now, the beauty of these sessions is that we are not looking into something which has already happened, because that's a piece of cake. Anyone can pick up any symbol and apply a number of indicators, oscillators, and find a number of reasons why they would have participated for a move which has already happened. But the real fun is when you are doing your analysis well in advance, so that you don't know what is going to happen in the past. And that is what I do in these sessions. And that's the beauty of demand and supply methodology as well, that you can pre-plan the areas where you would like to be buyers and sellers. And we are doing our analysis well in advance. And eventually, when the prices, they revisit these areas of demand and supply, that is the time these trades, they get triggered. And because I'm sharing these examples in advance, that does not mean that I've shared these examples and then we forget about it. We are looking at the before while we are doing the analysis, but once these uh, examples, they get triggered, we also review them so that you can see both the before and the after. And the beauty is when you're looking at these a number of examples where we are pre-planning our trades and eventually how they play out, that helps you build confidence in the methodology. And that is the idea behind these sessions, that you people see real life examples, and that helps you understand that the methodology is really effective. And eventually, if you want to shift from whatever you're doing to demand and supply, you can make that shift. Or even if you don't want to make that shift, you want to use it as a confluence along with whatever you have been doing, you can also incorporate demand and supply into your trade plan. All right, now before we move ahead with the today's example, we have two examples which are getting carried forward from the previous session. So we'll again do a review of them. And after that, we also have one trade which got triggered this week, right? So we'll review these three examples and then we'll start with the analysis for today. So just give me a second. Let me bring up the examples which are getting carried forward. So we'll start with the ones which were getting carried forward. All right. So the very first one is the one which was getting carried forward from the previous session. This is session number 24, which was on the 23rd of June. So if you look at 23rd of June, probably it would be something like this. Let's see, what date is this? Can you see 21st? And this is 24th, right? So when we did the analysis, if you go back to the session which was on the 23rd of June, The chart would be something like this. We planned, okay, this is the area where we probably want to be buyer. And you can see eventually prices came back into the zone after quite a while, which was on the 8th of October. And can you see it came into the zone? That is where we got our nice bounce, which is a little close to 3 is to 1. But again, when we were talking about our targets, we talked about that we don't have any fresh zone anywhere close by. So even if you're looking for a quality zone which is tested, which is right here, we still have a reward to risk ratio that is a little over 4 is to 1. And in the last session, I also talked about that we do have an area of demand which was formed here. You can see a drop based rally, and we said that once the move from the zone violates an opposing zone, we can also shift our stop loss from break even to the distal line of this um newly formed demand area. So if I do a candle replay, give me a second from here. So this is what we talked about, that we have a formation of a demand area. So at 1 is to 1, we can shift our stop loss to break even. And now the opposing supply is this. And after the violation of this supply, we can shift our stop loss below the distal line of this demand area. So you can see what happened eventually this week. Prices, they definitely went a little deeper into the supply area, but the supply was not violated. And since the supply is not yet violated, we cannot make that shift. We only make that shift once we have the violation. And you can see prices again came back and the demand was violated. So your stop loss was still at break even and it would have not been hit. So you're still in the trade. We haven't got the exit on this one. So that's your session number 24, which is getting carried forward. So it will still get carried forward unless and until we get an exit on this. The other example which was getting carried forward is, just give me a second, let me bring this up, is this one. Give me a second again. Perfect. So this was session number 36, which was on the 22nd of September. And you can see prices came into our zone on the 8th of October. Since then, we have been trading inside of the zone. Our nearest opposing zone is also pretty far away, which is showing us a reward to risk ratio that is approximately 5 is to 1. So this will still remain as an open trade for us because we have just been trading inside of the zone for the last 6 number of days. In fact, I'll say for probably 2 weeks, we have been just inside of the zone. Nothing is happening. So we have nothing else to do but to wait for the prices either to move down and hit our stop loss or start moving in our favor, wherein we can start trailing our position. So that's your second example, which was getting carried forward. And now we do have an example which got triggered this week, and this was from the previous session. So let me bring this up. So this is from the previous session, which is session number 39. And that is where we talked about that, yes, the quality scoring, I guess, was fine, but the probability was not really high, which made it as a type 2, type 3 trade for us. Now, how do we take type 2, type 3 trades? The way we take type 2, type 3 trades is we wait for the prices to come inside of the zone. Once the prices are inside, then we'll have to wait for a formation of a bullish or a very bullish candle, depending upon your personality style. But the thing is, on this particular day, which is the 15th of October, you can see we hit the zone, and after hitting the zone, we already got a reaction. So this is where you would have missed your opportunity as a type 2, type 3 trader, because prices, they never went inside of the zone. And by the time prices came a little deeper into the zone was already tested, which will make it as a non-qualified trade setup for us, because we always prefer to trade fresh zones. We don't want to trade zones which have already been tested, right? So that is where it gets disqualified for us, because it has already been tested. So this will be closed as no trade, and the reason for that is the time it got tested the very first time, we never had the opportunity to do it as a type 2 or a type 3 trade. All right, so that takes care of the examples which were getting carried forward, and also the example from the previous session which got triggered this week. So now we can start with our analysis for today. So let's get started. Perfect. So whenever it comes to trading, I always talk about being mechanical and rule based, and uh, why we should be mechanical and rule based. I have explained this in a video. Title of that video is How to Start Trading. In case you have not yet watched that video, the link is available in the description. You can go through that video. A very, very important video. The process I've explained, you have to go through that process. There is no bypassing it. You might have to do that process twice, thrice, but once you have gone through that process a few times, that helps you build confidence in your methodology and also fine tune it. And that also helps you be a more rule-based trader versus trader who is making his or her decisions based on emotion. So very, very important video, very, very important steps I've explained. So make sure you watch that video, go through that process. So yes, like that video talks about that we need to be mechanical and rule based, and to be mechanical and rule based, we need to create something which is called as a trade plan. Now the challenge is, if you're learning a new methodology, or if you have just started learning trading, it's not very easy to create a trade plan from the very first day. The reason is, to create a trade plan, first we need to have a good enough experience of that methodology. Only if we have experience of that methodology, we can convert it into a rule based system. So how do we go about it? And that is where I have a ready-made trade plan for you, which is a combination of two documents. The first one is your trade plan steps. We can call it as the flow chart or the walkthrough, which guides us what we need to do as a demand and supply trader step by step. Now, all these steps, they have their own elaborate rules as well, and those rules are available in the rule book. And again, this rule book is a conservative approach, because whenever you're learning something new, definitely makes sense that we start a little conservative. As you start having more and more experience, if you want to make some modifications to it, those modifications can definitely be done. But at least you do have a starting point for you, using which you can start planning your trades very mechanically and rule based. So what is my step number one when we start planning our trades? Step number one is, we need to define our trade purpose. Now the question is, what do we mean by trade purpose? Trade purpose implies the expected duration of the trade, which is from the time you enter the trade to the time you exit the trade. Now, when I'm talking about the exit can be the target, the exit can be break even, the exit can be the trailing stop loss, the exit can also be the stop loss, any kind of exit. So the question is, why do we start with the purpose of the trade as our step number one? And the reason we do that is because when we are doing our analysis, the charts that we use, they are time-based charts, and we have a number of time frames available to us. So the very first challenge we face is that I have so many options available to me when it comes to time frames. So out of these a number of time frames, which time frame should I be using for my analysis? And to overcome this challenge, we do not start by randomly selecting any time frame. We start by first defining our trade purpose, because logically, the longer I want to be in the trade, the bigger the time frame I should be using for my analysis. And similarly, the smaller I want the duration for the trade, the smaller the time frame I should be using for my analysis. So that is the reason our step number one is to define our trade purpose, because once we have defined that, it will be much easier for us to choose our time frames based on the expected duration of that particular trade. So what I've done is, I have divided these trades into 4 different purposes, and we call them as the hourly income, daily income, weekly income, monthly income. Hourly income implies a trade where my expectation is that this trade can last for an hour or maybe few hours. Daily income, a trade which can last for a day or few days. Weekly income, a trade which can last for a week or few weeks. And monthly income is a trade which can last for a month or few months. Now, very important, by definition, I say daily income is a trade which can last for a day or few days. But when you're trading markets that are not 24-hour markets, like in these sessions, we take example from the Indian NSE market. So this market is not a 24-hour market. And I'm pretty sure all of you would have experienced that in such markets, whenever the market opens, some symbols they gap up and some symbols they gap down. Now, because of this gap up, gap down, what can happen is, if you get a gap in your favor, you might get profit which is bigger than what you were expecting on that trade. But if you get a gap against you, you can also lose more than what you were willing to lose on that trade. So we understand that whenever we hold a position overnight, by holding that position overnight, we take that inherited overnight gap risk, which cannot be avoided. And that is why my recommendation to all of you is that initially our hourly dailies should be done strictly as intraday trades. We don't want to keep them as overnight trades and take that unnecessary overnight gap risk. Now, when it comes to weeklies and monthlies, here anyhow we have no choice. We will have to keep these positions as overnight positions, because we are not anticipating that we'll be getting the exit the same day. So here you have no choice, but that does not mean you cannot have gap against you. It can still happen. But since we are leaning against some bigger time frames, the probability definitely goes a little lower, but it can still happen. But as you start having more and more experience, you start building up confidence. If you want to include even daily incomes into overnight trades, that can be done, because by definition, daily income implies a trade which can last for a day or few days. So again, initially hourly dailies intraday, weekly monthly is overnight. Eventually, you can also include daily incomes into your overnight trades. Now, step one was I need to define my trade purpose, and let's assume I opted I want to plan monthly income trades. Now, once I have selected my purpose of trade, what is going to happen? From the rule book, I'll get to know what time frames I should be using. So if you go to page number 28 on the rule book, we start with the topic, which is multiple time frame analysis. Because demand supply methodology is not based on single time frame, demand supply methodology is based on multiple time frame analysis. So what are the multiple time frames we use? We use a minimum of 4 different time frames, and we call them as the higher time frame HTF, intermediate time frame ITF, lower time frame LTF, and the refining time frame RTF. And every time frame has a designated purpose. Higher time frame is used for demand supply curve analysis, intermediate is used for trend analysis. On the lower time frame, we identify areas of demand and supplies for our entries and exits. And the refining time frame can be used for multiple purposes like fine tuning the zone, different kind of entries like your type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Next, what are the 4 different trade purposes? We have already talked about it. What is HIT, DIT, WIT, and MIT? So now the question comes that for every purpose of trade, what will be my 4 different time frames? And we get the answer from this table. Now you can see in this example I opted, I want to plan monthly income trades. So now I know as a monthly income trader, my time frames will be monthly, weekly, daily 60. Monthly will be the higher time frame, which is used for curve analysis. Weekly will be the intermediate, used for trend analysis. Lower time frame will be daily. That is where we get our SCTS from. SCTS stands for stop loss entry, target, and size. And in case I need to use the refining time frame, then my refining time frame will be the 60 minutes chart, which can be used for multiple purposes like fine tuning the zone, type 2 type 3 entries, or in case I need to apply some additional rules, that is also where this time frame can help us. Now mind it, this table that we have on page number 31 is specifically for the NSE market because it is only open for about 6 hours 15 minutes during the day. It's open for a very short duration. But if you're trading markets that are open for longer durations like commodities, forex, cryptocurrencies, then you can refer to the table that we have on page number 32. So going back, as soon as I selected my purpose of trade, now I know what time frames I should be using for my analysis, plus what is the purpose of each and every time frame. I also have the clarity to it. So my challenge number 1 is taken care. Now, I do know my time frames. I also know what analysis I need to do on each and every time frame. Now we have to move on to our second step, which is select scripts. And why do we need to do that? Because yes, I do know my time frames, but if I talk about the NSE exchange, we have over 2000 plus symbols listed on the NSE exchange. So humanly, it's not possible that every day I sit and analyze 2000 plus symbols. So what we need to do now is we need to have a process in place which can help me select a smaller list out of this bigger list. Because if I have a small list, I can do my analysis almost every other day. But going through 2000 plus symbols every day is not an easy task. So how do we do this? For this, we use certain computer programs which are called as scanners or screeners. And the way these computer programs, they work is that we input certain conditions into them, that these are the conditions I'm looking for. And then that computer program will identify that out of these a number of symbols, which symbols are matching with those conditions. And whatever is matching with those conditions, it gets shortlisted for us, and that is how we get a smaller list. Now, very important thing which you always have to remember, irrespective what scanner or screener you're using, whatever results you get from these scanner screeners, you can never blindly buy or sell these symbols, because scanner screeners, they never tell you what you need to buy or sell. They only help you getting a smaller list. Once you have that small list with you, you will have to analyze them manually one by one. Whatever matches with your trade plan might be an opportunity for you. Whatever doesn't match with your trade plan, you'll simply skip it. Now, a few examples of these scanner screeners. Example 1, if you go to my website, you will see under the free tab, I have created some scanners for you, which are based on some moving averages and helping you shortlist symbols. Second example, if you go to my YouTube channel and search for scanner, you'll be able to find a few videos, different scanners, different logics. You like any of those, you can use that. Third example, on my YouTube channel, search for sector analysis. You'll be able to find a video on sector analysis as well, which can help you in shortlisting symbols. Fourth example, on my YouTube channel, search for top-down analysis. You'll be able to find a video on top-down analysis as well, which can help you in shortlisting symbols. So these are 3-4 different examples of scanner screeners which can help you shortlist symbols. And let's look at few of these examples so that you can also understand how step 2 has to be done before we move ahead. So like I was talking about, that once you go to our website, just give me a second. Under the free tab, we have stock screener. Because I want to plan MIT trades, I can run the long scan and the short scan. So here you can see the long scan is giving me a list of about 14 symbols, and the short scan is giving me a list of just one symbol. So like I already said, very, very important. Just because I'm getting these 14 symbols in the long scan does not mean I can blindly buy these 14. And similarly, just because I'm getting this one symbol in the short scan does not mean I can blindly sell this one. So do not assume that the results that you're getting can be blindly bought or sold. The job of the scanner is never to tell you what you need to buy or sell. The job was, since I can't analyze 2000 plus symbols every day, help me get a smaller list. It gave me a list of 15 symbols, which I can now analyze. Out of these 15, if anything matches with my trade plan, it's an opportunity for me. If nothing matches with my trade plan, I don't have any opportunity available to me. So many times what can happen is when you're using the screener, the list which you get might be a very small list, like you can see in the example of short scan, we only have one symbol, or maybe at times it is not generating anything because nothing is matching with these conditions. So if you want that my list should always be a little bigger, because the smaller the list, the smaller is the probability that you might be able to find something which is in sync with your trade plan. But the more number of symbols you're looking at, the higher is the probability you might find something which is in sync with your trade plan. So if you want that the scanner should be giving you a little bigger list, not a very small list, then what you can do is you can see that in the scanner I've given 5 different conditions. You will disable the third one, run the scan again, and I'll do exactly the same thing for the short scan. I'll disable the third one and run the scan again. And now you can see initially it was giving me 14, but now it is giving me 110 results. And on the short scan it was giving me 1, but now I have 16. So we have 126 symbols to look into. Now 126 is not a very big number. I'll say half an hour, 45 minutes, it can easily be analyzed. But still, if you feel it's a big number, you further want to filter it out, you can use different filters. Example, I can say I don't want from the cash segment. Maybe I only want the symbols which get traded in futures, and now you can see from 110 I'm down to 40. So this is how you can use different scanners, different filters to make your list bigger, to make your list smaller. And if you go to the screener section on this website, you will see you have over 150,000 scanners available to you. Some of them are based on fundamental analysis. Then you have your top love, you have candlestick patterns, you have range breakouts, you have bullish scan, you have your bearish scan, you have your intraday bearish, you have intraday bullish, crossover. So n number of scanner screeners, and this is an example of one website. If you do a Google search, you'll be able to find a number of websites and number of scanner screeners available to you. Now in this example, you saw that we got a list of about 126 symbols. Now the next challenge which you will eventually realize is that when you start analyzing these symbols, most of the symbols in this list, they do not have a quality zone, quality demand zone, or a quality supply zone on the lower time frame. And now the problem is, if you don't have a quality zone available, you can't plan a trade, because to plan a trade, the first criteria is I need to have a quality zone against which I can lean and I can participate. But if you don't have a zone, you can't participate. And the reason for that is because all these 150,000 plus scanners I talked about, they are either based on conventional technical analysis or fundamental analysis, which is why just because something is getting shortlisted does not guarantee that you'll have quality demand supply zones on those symbols. So they might have some zones, they might not have, but you will see majority of the times they don't have. And some of them which might have some quality demand supply areas, those zones might be far away from the current market price, due to which you'll have a longer waiting period before the prices are back into your zone. And during that waiting period, what can happen is whatever price action develops, it might even disqualify the setup for you by the time prices are back into your zone. So these are some of the challenges we face when we are using scanner screeners, which are not based on demand supply and based on conventional technical analysis and fundamental analysis. And to overcome these challenges, we have also created two custom built tools. One is called as the alert service, the other one is called as the screener. Now again, understand this, that these are not call giving or tip giving services. These are also scanners which are now purely based on the demand supply methodology, demand supply concept. And both of them, they work in a different way. So let's quickly touch upon how they work, and I'll show you a few examples. But if you want to understand them more in depth, the link to the walkthrough videos are available in the description. You can go through those walkthrough videos to understand them better, how they work. So alerts, what alerts basically does is that it keeps monitoring. We have some predefined list, and in fact with alerts you can also create your own list. And whatever list you create, it keeps monitoring that list of symbols during the live market. And as soon as you have a formation of a demand area or a supply area, it notifies you. And we do have demo channel for NSE, for MCX and Forex, and I'm showing you the example from the NSE channel for the 18th of October, which was Friday. So you can see at 11:15 on some symbol, we had a formation of drop base rally on the 60 minutes time frame. This was the proximal value. This was the distal value. So as soon as the zone was formed, you immediately got the notification. This is on the 15 minutes chart, 5 minutes chart on the daily time frame. Again, for the daily 5 minutes, then you can see 15 minutes. So you can see during the live market, as and when the zones are getting formed, you keep getting these notifications that at what time, on which symbol, what kind of structure has formed, on which time frame, plus what is the proximal value, what is the distal value. So again, as soon as you get to know where these demand supply zones are getting formed, you can go to those charts. You can match those demand supply areas with your trade plan. If they qualify, there might be your opportunities. If they don't qualify, you'll simply skip them. So that is what alerts does, that during the live market, as and when the zones are getting formed, it notifies you. And if you talk about the screener, the way the screener basically works is, again, here also you can define your list of symbols. Like here you can see I've given a list of about 40 symbols, and then I've given my condition that my proximity percentage should be 1%, which means when the current candle is within 1% to a demand area or a supply area, shortlist that particular symbol for me. Now, that demand supply zone could have formed today, it could have formed a week ago, a month ago, and a year ago, 10 years ago. It doesn't make any difference. So it has nothing to do with the zones which are just getting formed today, right? It takes care of all the zones which are available on that particular time frame. So like here you can see I gave a list of about 40 symbols, and it is telling me, okay, these are the 3 symbols which are closer to demand, and these are the 4 symbols which are closer to supply. So in a way, if I'm only looking at long trades, I don't have to now analyze those 40 symbols. I know I can only look at these 3 because these 3 are closer to demand areas. So just as an example, if I go to the first one, which is Hindalco, you will see that will have a formation of a demand area on the current candle, or it will be closer to a demand zone, which is why it is getting shortlisted. So you can see on the last candle, we had a formation of a drop based rally. Similarly, if I go to Titan, here also you'll be able to see that will be closer to a demand area. So you can see we have a demand area which in fact got tested on Friday, and we also have a fresh zone which is just below it, and we were pretty close to it. In fact, we are still pretty close to it as far as the low is concerned, and that is why it is getting shortlisted for us. And plus, once you have created this, you can also look at the different time frames. So currently I'm on the daily time frame, so it is giving me the results based on daily. If I change it to weekly, now you will see I'll get the uh, results based on the weekly time frames. So can you see it is telling me that for demand, we are closer to weekly demand, and you can see on Titan, I'm already on Titan. We have a weekly zone. We were pretty close to it. Rest of them are closer to supplies. So this is how the screener basically works. It has nothing to do with the zones which are getting formed on the current day. It has to do with the proximity of the current candle to a zone which might have formed today or a number of days, months, or years ago. All right, so that's your step number 2, that you need to get a smaller list of symbols because you already know your time frames, which were, monthly, weekly, daily, and 60. Now I need to have a list of symbols. I showed you a number of ways to do it. The process can also be as simple as, I don't want to use this. I just want to analyze my Nifty 50 stocks, or maybe I have my own favorite list of stocks or whatever markets you're trading. These are my favorite symbols, and those are the only symbols I want to analyze. So choice is yours how you want to get that list. But obviously, the more in sync you're with demand and supply, the probability increases of finding something which is an exact replica of your trade plan, and that too by not going through a very big list of symbols, by going through a smaller list of symbols. So again, your choice how you want to get that list. But once you have that list, now we have everything required to move ahead. We know our time frames. We know what symbols we'll be analyzing. So what we'll do is we'll pick the very first symbol and go to the lower time frame. So now the question is, what is my lower time frame? We got the answer from our step number 1, that as a monthly income trader, my lower time frame is daily. So we'll go to the daily chart, and on the daily chart, we need to identify a zone. Now the good news is that our demand and supply zone indicator now can be tried as a 7-day trial. And how do you get this 7 days trial? You can just go to the description. In the description, there is a link to a Google form. So just fill that form with the correct information. So make sure the information you're providing is correct, because we need your TradingView username to activate it for you from the backend. If you're providing an incorrect TradingView username, or if you make some typo errors, it will not get activated for you. It will get activated for someone else. So as long as you are providing the correct information, it will get activated for you within 24 hours. And once it gets activated, you will get the notification on TradingView itself that it has been activated for you, and that is when you can start utilizing it for 7 days, and you can try it for free. It will work with all the features, on all time frames, multiple time frame analysis, everything. So since you will now have access to the indicator, we'll do our analysis purely based on the indicator. So let's assume this was my very first symbol, which was shortlisted by the screener or whatever methodology I used. So my next step was to identify zone on the lower time frame. Lower time frame, is daily in case of a monthly income trader, and I'm on the daily time frame. And since the indicator is applied, you can see it is automatically identifying my demand supply zones. So from the current market price, my nearest demand zone is this, which is a drop based rally. So let's mark that. So step number 3 was to identify a zone. Now this thing is also uh, more of automated for me. I don't have to identify, the indicator will identify for me, and that is what the indicator has done. So yes, I was supposed to find a zone on the lower time frame. Do I have a zone available? The answer is yes. Now once we have identified the zone, does not mean we can blindly buy. And this is the biggest mistake demand supply traders they do initially. They find any demand area, blindly start buying at that demand. They find any supply area, blindly start selling at that supply, which is incorrect. You can never blindly buy or sell at any demand area or supply area. Once the zone has been identified, the next step is to qualify it, and only if it qualifies based on your trade plan, it will be your trading opportunity. And for qualification, we have a two-step process. In step 1, we'll qualify it based on certain conditions, and in step 2, we'll qualify it based on the booster scoring. So the first thing we'll check is that the zone I have identified, is it a case of level on top of level? Now, why do we start with level on top of level? Because if it proves to be a case of level on top of level, we might have to shift from a zone we have already identified to a different zone. So that is the reason, if some modifications are required, we want to check that, and then we want to move ahead. So how do we check whether a zone is a case of level on top of level or not? Very simple concept. If you have an intermediate time frame zone, and the same intermediate time frame zone divides into multiple zones on the lower time frame. So again, when your intermediate time frame zone is getting divided into multiple zones on the lower time frame, we call it as a case of level on top of level. So what we understand from here is that to be a case of level on top of level, my lower time frame zone has to be inside the intermediate time frame zone, which we call as a coinciding level. So if we have a coinciding level, it might be a case of level on top of level, but if you don't have a coinciding level, it can never be a case of level on top of level. So let's verify the zone we have identified. Does it coincide with any intermediate time frame zone? And in this case, intermediate would be weekly. And you can see wherever my lower time frame zone is, we don't have any intermediate time frame zone here, which means it is not a coinciding level. And if it is not coinciding, it cannot be a case of level on top of level. So it's not a case of level on top of level, no modifications required. The zone is not because of a gap, therefore gap rules will also not apply. Next, talking about pivot and non-authenticity. You can see that this zone is definitely a drop based rally, and to drop based rally, we always apply pivot and non-authentic rules. Now, the aggressive approach talks about, if I go to the rule book, you can see that if you go to the rules of pivot, the aggressive rule says that before applying the boosters, make sure the move from the zone was able to violate at least one opposing zone on the intermediate time frame. So what we want to do is, because we know that such kind of zones can be a little lesser probability, we want to see some positive factor. And the way we are adding that positive factor is that the move from the zone should have violated an opposing zone. So if this is demand, then my opposing zone would be supply, and that supply should not be of the same time frame, it should be of the intermediate time frame. So let's verify that the move from this area, did it violate an opposing zone on the intermediate time frame? So again, if I do a replay, you can see somewhere around here the zone was formed, and while the zone was formed, our opposing intermediate time frame supply is right here, which is a rally based drop. And you can see when we started moving up from there, this was definitely violated. So going with the aggressive rule, absolutely yes, this is qualified for us. Now going with the conservative rule has two conditions we need to look for. Condition number one, we need an impulsive move on the intermediate time frame, which we can already see that was my last pivot high and it breached it and made a new pivot high. So we already have one of the condition applicable. And the second condition is we also want to have an authentic zone on the refining time frame, which means on the refining time frame, I need a rally based rally structure, which is missing in this case. You can see if I zoom out, we do have a drop based rally, but we don't have a rally based rally structure. So technically, if I go with the aggressive rule, this is qualified for me. But if I go with the conservative rule, this is not qualified for me. So let's assume for a minute that I am a I'm an aggressive trader and I'm planning my trade based on the aggressive rule, which definitely qualifies the zone. So now I know the zone is qualified and unstable equilibrium is not applicable because for that the leg out has to go below the basing, which is not happening in this case. So going back, the only applicable condition was pivot non-authenticity, and based on my aggressive rule, it is qualified for me. But if you're someone who's following the conservative rule, this is not qualified for you. This is not a setup for you. So yes, after looking at the conditions, is it qualified? The answer is yes. And now that I know it's qualified, I can move on to the next step and do the booster scoring. So let's bring up the boosters. The very first one is freshness. The zone is definitely fresh, gets a score of 3. Strength, we have an explosive move, gets a score of 2. Time at the zone, we only have one candle, gets a score of 2. Reward to risk ratio, we are taking as an assumption because based on the arrival, reward to risk ratio can change. Now, what is the location? If I go to the monthly chart, you will see that we are located at the best location. We have this rally-based rally structure and we are planning our trade at the best location. So best location gets a score of 2. Now, whenever you're planning your trades at the best location, trend becomes irrelevant. Doesn't matter whether you're in an uptrend, downtrend, or sideways, it will be a score of 1. But if I go to the weekly time frame, which is intermediate, you can see the indicator is telling us that we are in an uptrend. We have violations of supplies, which means we are probably in an uptrend. So you can see the indicator also does the zone violation trend analysis for us. An up arrow would mean we are in an uptrend. A down arrow would mean we are in a downtrend. But if you have an up arrow and a down arrow, both of them together, that will imply sideways. Now, move from the zone, we need minimum 4:1. We already have a move which is much bigger than 4:1, gets a score of 2. Level on top of level, we have already verified, not a case of level on top of level, not even coinciding. Trap becomes irrelevant, and the reason for that is it is already a high probability trade setup. So whether you get a 0 or a 1, this will still remain as a high probability setup, but it will be a score of 1. And the reason is if I take a horizontal line wherever the proximal is, and if I start pushing it up, you can see almost this area in the past has beautifully acted like support, acted like resistance, acted like resistance, acted like resistance, acting like support, acting like support, here also acting like support. So we have almost a textbook example of support resistance. Now, what is going to happen? People who believe in support resistance, because they believe they should act like support, they will be buying somewhere around here with their stop losses below this, and those stop losses will be sell orders. And similarly, if you get a breakout, then people who believe in breakout will also start selling. So we understand by the time we are getting into this area of demand, we might have quite a few people who might start selling because of their stop losses, because of the breakout trading. And now they are making two novice mistakes. Mistake number one, selling after a decline in price, which means they are selling at a cheaper price. And also in an area where the chart has proven to us that back in history, demand exceeded supply, which could be the only reason for prices to move up. So yes, that possibility is there that this might work like a trap, for which I have already given it a score of 1. So if you look at the overall scoring, we have a score of 10 for quality, 6 for probability, which makes it as a high quality, high probability trade setup, and high quality, high probability can be done as a type 1 trade. So moving back to our flowchart, yes, it can be done as a type 1 trade. Now the next thing is, no matter how high the quality or the probability, we understand that any trade can be a stopped out trade. So we also need to be ready for the worst case scenario, for which we'll do our risk management by doing proper position size calculation. Whenever the prices are back, we'll also have to re-verify, because the markets are not static, markets are dynamic, conditions are changing almost every other second. So before we place our order, we'll again have to re-qualify the way we just did now, that does it still match with my trade plan. If the answer is yes, you place your order based on the entry type, in this case a type 1 trade. And once your order has been executed, the last step is your trade management, where step 1 is 1:1, we make it as a break-even trade. And after that, if we get the opportunity to trail onto it, we start using a trailing stop loss, and that is how we plan trades in a very mechanical and rule-based way. So that takes care of today's example. And before we get into the questions that I have in the chat box, I would like to add, if these sessions are helping you, do hit the like button. And if you have some friends, family members, or trading group, you can also share the links to my videos, to my courses there. And plus, since we are also providing now a 7-day free trial of our demand supply zone indicator, you can also share the link to that Google form. If somebody wants to try it out, they can fill that form and they can get a 7 days trial for it. So let's see, what do we have in the chat box? All right. So for MIT trade, there are two zones on the intermediate time frame. Okay. So it is a case of level on top of level. So see, again, irrespective whether it is an MIT, DIT, HIT trade, when the intermediate time frame zone, just give me a second. When the intermediate time frame zone divides into multiple zones on the lower time frame, so your intermediate is getting divided into multiple zones on the lower time frame. So what you're saying is there are two zones on the intermediate time frame. So the fact is, I go on any time frame will always have a lot of zones. So just as an example, if I go back to this, can you see, if I go to the intermediate time frame and if I zoom out, I have one zone, I have another zone, I have another zone, I have another zone. So we'll have a number of zones. But we are not concerned with how many zones we have. What we are concerned with is that the lower time frame zone that we have identified, is it part of an intermediate time frame zone? And if yes, do we have only one zone or do we have multiple zones? So that is what we need to check. The other zones on this intermediate time frame as of now has no meaning for us. All right, so let's say, it is, no, it is, so what you said is we have two zones on the intermediate time frame. So is it a case of level on top of level? No. But the lower zone is tested by upper zone. In such case, should we? So again, if you're saying that we have multiple lower time frame zones inside of my intermediate time frame zone and the lower time frame zone is already tested, yes, this is something you will see many times. And you can see I've already given this as a rule in our rule book, that these are some of the characteristics of cases of level on top of level, that in case of demand, the lower zone might be tested by the upper zone. Similarly, in case of supply, the upper zone might be tested by the lower zone. So we have taken such examples in the past. But what happens is that, whatever rules we have in the rule book, they cannot be covered in one example. So what I would recommend you, Amit, is one, you can go through quite a few sessions from the past, or you can keep, joining these live sessions regularly, because almost every other session we have different examples where we'll also be taking care of such examples. So yes, these are some of the characteristics, and we have taken such cases in the past. So probably go through some previous sessions. I don't know exactly in which session that kind of an example would be there. Or like I said, keep joining these sessions every weekend. Some or the other day we'll have an example where we'll be again taking such a scenario, and that will probably help you understand it better. All right. Let's see. It is good thing you are showing that not all trades will be winning trades, since losing trades are part of the parcel of trading, as well as winning ones. Risk management, absolutely. And this is one of the biggest challenge, because what I've seen is everyone is looking for that holy grail where every trade I take is a winner, which can never happen, right? And that is something which I can guarantee you, that there is no such strategy in the world where you'll not be losing money, or you'll be having all your trades as winning trades. You will be having losing trades. So that is why you need to understand that it is part of the parcel. The best thing we can do is ensure that loss does not become a very big loss, and we exit that position with a small loss, so that when we get good reward to risk ratios, those good reward to risk ratios take care of those small losses. All right, this live sessions are extremely helpful in reinforcing the methodology, because it is logical and it makes sense, learning quite a bit. All right, good. Thank you for your feedback. Thank you for starting the free trial. I have used the indicator. I have been following these live sessions since the first, and I have seen it's fruitful. Perfect. First time I have seen greens more than reds. Okay, so happy to know that you're seeing some greens. But again, I'll add, whenever I get such comments, the very first thing that strikes me is, just because you're doing demand and supply, do not have that mindset that, I'll be having every trade as a winning trade. Yes, there can be weeks, there can be months where you might be having a lot of greens, but there can also be months and weeks where you might also be having a lot of reds, right? So do not be scared of it. So do understand you'll have both sides of it, but I'm happy to know that as of now you're having more of greens and the things are working for you. I've enjoyed learning your practical sessions on supply and demand. Do you intend to hold similar live training for option? I'll tell you the fact. The fact is, I personally do not trade options, right? So since I don't trade options, now there are a lot of reasons why I don't trade options. Eric, one is that if I talk about the Indian markets, the liquidity is a very big issue, and specifically when it comes to applying some of these strategies that I talked about, will not get liquidity for it. So that is the reason I don't trade options. Plus, there are more challenges as well. One is, the time it takes to plan an option trade. Within that time, probably I can look at 10 trades on the stocks, which is just based on demand and supply versus doing my calculation for options. So since I'm not a very I won't say regular. The fact is, like I said, probably in the last 2 to 3 years or maybe 4 years, I've not even taken a single options trade. So that is the reason I'm not very inclined towards it, and I would not like to start sessions for options because I myself am not doing it, right? So I apologize for it. But otherwise, yes, the course which I have done for the options, if you start applying it with time, yes, you'll start understanding it. I have tried to cover almost most of it. So it's just a matter of practice, which you can start with, let's say, maybe a very small amount, or maybe even with simulated account if you wish to, right? That is how you can start practicing. Would you consider a zone to be a level on top of level if it is on higher time frame? So see, if the zone is inside of the higher time frame demand area or supply area, then we don't call it as a case of level on top of level. Then we call it as the best location, which is either the very low of the curve or the very high of the curve, right? That is where we already giving it those positive factors, like trend now is irrelevant to us. In fact, if you don't have good reward to risk ratio on the lower time frame, you can even use your intermediate time frame. So based on the higher time frame confluence of a coinciding level, whatever advantage we want to give, that is already incorporated in the trade plan. In a sense, the trend becomes relevant. I just gave you two examples. Trend becomes relevant. Your reward to risk ratios can also be taken from the intermediate time frame, provided your lower time frame is not showing you a very good RR. All right, so I've taken demand supply zone alerts, but we don't get tested zone alerts. See, again, when it comes to alerts, the alerts that we provide you through our Telegram channel, uh, in fact, no. If you think about it, you're talking about alerts, not the screener, right? So I was in a way thinking about the screener. So now, if you think about it, how alerts they basically work, right? Alerts, they always work as soon as the zone is formed. So let's assume you have a drop, you have a base, and you have a rally. Now, as soon as this rally completes, the alert will be generated. So at the time of alert, the zone will always be fresh. So that is the reason you can never have an alert for a tested area, because alerts are based on the formation of a zone. A tested area would mean a zone which is already formed and now the prices are coming back. So with screener, you can still shortlist symbols where prices are coming back to tested zones, but alerts will always be for fresh areas. And the reason for that is alerts are generated at the time of formation of the zone, not at the time of arrival to the zone, right? So that is the distinction between the two. And that is the also the primary reason why alerts will always be for fresh zones, because alerts are generated at the completion of the leg out, and at that given point of time the zone will always be a fresh zone. So again, if you want to identify prices coming back to tested areas, that is where you can use screener. So I can just show you a very simple example how screener can work for it. So let's say I change this to weekly, just so that the screener works a little faster. So what I can do here is I can say that my proximity should be 0 now. Why it should be 0? Because I want the prices to be inside of the zone, and because it has to be 0 currently, you will see it will give me 0 results, right? So you will see 0, and then I'll tell you why. So let it refresh. Okay, why is it still giving me okay, let me just see. Maybe the zones were formed on the current candle, right? That could be the reason why it is giving me these results. So let me just check. If I go to BAJAJ, FI, and otherwise it should not generate. Perfect. So you can see you have a formation of a zone. That is why it is getting shortlisted, right? So now if I want the zones which are tested, so what I can do is I can say that show tested zones, because show tested zones was disabled. So these three, I would be having formation of the zone on the leg out candles. That is why they are getting shortlisted. But now you can see it is giving me a list of symbols where I would be inside or touching a tested zone. So if I go to BPCL, you will see on BPCL, I will be touching a demand zone on the current candle. And can you see that is why it got shortlisted for me. Now, if you want that, here you can see the closing is outside, the low is inside. Now, if you want, I should only get the symbols where the prices are currently trading inside of the zone. Then I can change my proximity method from high, low to close. So now it will only show me the symbols where I am already inside of a zone. So let's wait for a few seconds. So let's take as an example Infi. So you will see on Infi, currently I will be inside of a weekly demand area, and that is why it is getting shortlisted for me. So that is how you can make those modifications to the screener. So with the screener, yes, you can find areas, whether it is tested, whether you're inside the zone, whether you're getting closer to the zone. So all those things can be done in the screener. But when it comes to the alerts will always be for a fresh area, because alerts are generated as soon as the leg out candle completes. So I just showed you example how you can identify if you're only looking for symbols where you are probably touching the zone, or the current candle is inside of the zone. All right. So do you also provide calls for tested zones on higher time frames? So like I said, we don't provide calls or tips, but yes, I just showed you that using the screener, this can be done. And that is why I just showed you as a live example that on screener it is possible. You can provide your list of symbols. And let's say if you're doing monthly income trades. Now, just as an example, if I'm doing monthly income trades and I want to identify symbols where I'm currently trading inside of a monthly demand area or a supply area, I can change this to monthly. I can go to my settings and I can say I want tested zones, and the closing should be inside and it should be 0%. And here I can also say I want all zones, because for curve analysis, we don't require quality areas. So now it will give me the results for the symbols where I am currently at the best locations for the monthly. So you can see on Asian Paints and Hindustan Unilever. So if I go to Asian Paints, you will see on the SIA. In fact, let me do this here. If I go to ASIAN, Asian Paints, you will see that on the monthly, I will be, you see we're currently inside of a monthly demand area. So this is how this can be done. You can use your scanner based on, whatever your preferences are, right? So with the screener, it is definitely possible. But not with the alerts. So let's change it back to my default settings whenever I show you examples. So let's keep it something like this. Perfect. All right. So I've already answered that. Another great session. Looking for. Okay, perfect. So that brings us to the end of today's session. Thank you so much for joining in. Yes, I will be seeing you now next Sunday. Till then, stay safe. Enjoy your evening. Take care. Bye bye.